Hello everyone. We're going to use this trial balance here in Excel to illustrate kind of how an accountant would go through the process of thinking through adjusting entries and so forth here. Now, first thing I want you to remember is that when you look at examples of trial balances in any textbook or anything where they're trying to teach you this, they'll either have it adjusted or unadjusted at the top. You'll see a label. That's not going to happen in real life. This is what it's going to look like in real life. It'll just have the date, you'll have the name of the company, you'll have some numbers, debits and credits, you may have some of the detail about what changed during the accounting period, but the computer doesn't know if you've made all your adjusting entries or not. It just says a trial balance. And of course it has to balance, and we always know that it's going to when we use software. And just to make sure you understand it down here, the debits equal the credits. We have each account and we have one balance in this trial balance. So we're going to look at this, we're going to make some adjusting entries as needed, and then we're going to have an adjusted balance. So as we go down, accountants would typically go down and look at each balance and decide whether or not they needed to do adjusting entries. Now, when you get to accounts receivable, first of all, adjusting entries are almost never made to cash. So the first one we're going to deal with is accounts receivable. Now, what adjusting entry would necessarily need to be made there? Typically, we're talking about the allowance for bad debts. So there's nothing on this trial balance to indicate how much that is. So either they have not done that in the past, and that's new, or they did it and then it's been reversed out or something of that nature. So if we were going to make an adjustment there, we would need a line here for our allowance for bad debts. And the normal balance on that would be a credit. And let's say that we estimate that it'll be 2% of accounts receivable. That would be our accounts receivable times 2%, or 0.02, 1,200 would be your credit in the adjusting entries. Sorry about that. Equals. Now we make sure our formulas are working. So we need a formula that's going to add those together, and we're going to copy it from down here, and we have that $1,200. Our debit is going to be to bad debt expense, which also is not here. So we also need a total, there we go, for our adjusting entries. And you'll see that we credited and debited, so we're good to go on the allowance for bad debts. Now, if there had been an allowance here, we would figure out what it should be and then make the journal entry, adjusting entry for the difference to get it to, in this case, it was 0. We knew it should be 2% or 1,200, and so we make the adjusting entry for the whole 1,200. Okay, looking at prepaid rent, anything prepaid is going to be adjusted to the expense. We see down here that there is a rent expense. Now, let's say in that situation we're going to need to look up information about our rent and see if that has been adjusted or we've been doing that correctly. So let's say that we go to the file and we find out that we paid $12,000 for a 12 months of rent in advance. And we did that on, let's say, August 1st. Okay, so if that's the case, then on December 31st, where we are, we will have used August, September, October, November, December, 5 months, and we'd have $7,000 of rent still prepaid. And you see that our prepaid is only $4,000. So somehow we got too much in rent expense and not enough in prepaid. And it really doesn't matter why that is the case. We just know that we need to make the adjustment. It could have been because when they paid this $12,000, they put it all down here under rent expense. That may be one explanation. It could have been that we made some adjustments each month, meaning we adjusted for part of a couple of months and then forgot the other months, or we recorded our rent expense in various ways. Really, it doesn't matter why it's the way it is. We just need to adjust it to where it should be. So we're going to debit the prepaid rent. Now that's backwards. What normally we're taught is we're going to credit prepaid rent and maybe to use it up. But in this case, we're going to debit it because we're going up to $7,000. We're going to need to debit it for $3,000, and we're going to credit the rent expense for $3,000. And we're checking down here to make sure that our debits equal our credits. Okay, so that's how you might handle a prepaid. Prepaid insurance, same idea. Let's say we find out that we have a policy that we paid on a policy we paid $8,000 for 12 months on, let's say, November 1st. So that would mean that that's 700, and let's make that, let's go with $9,000. That's $750 a month. And so if you would have used November and December, and December 31st you would have 10 more months, or $7,500 in prepaid. Okay, so that means that when we have 11,000, so we're going to and again, it doesn't matter why that is incorrect. We just need to know we need to do 3,500 to credit that, and we need to debit our insurance expense down here for the same amount, the 3,500. Okay. All right. So that's how I might handle prepay, a situation. Now that's more normal in that we obviously had an asset that's been used up and we're going to move it to an expense. That's what we typically think of as an adjusting entry. Again, whatever it takes to get where we need to go, and notice that our adjusted balances over here are what we expected them. 10 months of insurance, okay, 7 months of rent, so forth. Computer supplies, let's say we count up how much computer supplies we have left, and we see that we have $13,000 of computer supplies left. That means we need to use up and move it to expense 32,000, get it to 13. Okay, computer equipment, that is, we depreciate. All right, so have we been doing depreciation on a monthly basis, or do we have to catch up for the year? It looks like we have some depreciation that matches our depreciation expense. So we would look up and see how long we've owned this computer equipment to see if that depreciation calculation is correct. And let's just say, for argument's sake, that it is, and it does not need any more adjustment. All right. So let's skip down here to accounts payable. Typically is not adjusted unless there are bills that came in after the year end that you didn't get in your accounts payable and they need to be adjusted for. Income taxes payable is almost always your last adjustment, because taxes, income taxes are always based on what your income is. So until you know what all your income is, you can't really do that. So that will be based on when we're all done. Unearned revenue, however, is a commonly adjusted account because that means that we've received revenue we haven't earned yet. We've received cash, but we haven't done anything. So when we actually complete whatever it was we were being paid for, we need to move it to our revenue. So now, if there had been too much put in revenue to begin with, there were times then where we have to look at our contract and decide that we have more in unearned revenue, which would mean we'd have to credit it and we would have to debit our actual revenue. So we pull out the contract. That's what we ought to do one way or another. And we look at it and we see that we have unearned revenue left of $3,000. That's how much we have not earned. So we need to debit unearned revenue $4,400 and look up what it is, and we'll say it's internet service revenue, and credit it for $4,400. Now that's the more typical way, but it can go the other way if you had things recorded that were as earned that aren't. Okay, loans payable. Now the thing that should happen with a loan payable is there should be interest. And I see some interest expense down here, but I see no interest payable. And the issue is, since we made our last payment, how much interest has been used? So if we're making a payment every month, let's say we made a payment on December 1st, it's now December 31st, then we would owe 1 month of interest. So if we were to look up our contract and find out the interest rate is 8%, then we would calculate that by taking the 92.6 times the 8% interest and divide it by 12 to get 1 month of interest. We're going to round everything just for kicks. And we're going to say that that's going to be, don't want to put it in the loans payable most of the time. Let's use interest payable. Make that a new account. That's going to be 617. As the, oops, put it in the wrong column. Let's put it right here. There we go. And the debit is going to be to interest expense for 617. Okay? So that may be one way. That's maybe it may be that there's been several months since you made a payment, or that you don't have to pay interest until the very end of the loan, and therefore you have to add up several months. It could be that some of the months were already done. It could be that there was an interest payable left over from the year before, and then all we need to do is adjust it to the new payable because we have been recording interest expense as we paid it throughout the year. Okay, we almost never make adjusting entries to capital, stock, retained earnings, dividends. We already looked at revenue from that standpoint. We could also look and see if there's any contracts we missed in terms of unearned revenue. Any of these others that might have an issue would have probably to do with bills that were missed or something like that. We already talked about depreciation. We've already dealt with insurance and rent. Now, another one that often is missed is salaries and wages. Salaries and wages. If I see salary and wages, I have a hunch that there are salary and wages payable, meaning people have worked but they have not been paid. And so I go back through time cards to figure out how many hours and how much they need to, are owed at December 31st since the last time we made them a payment. This is another situation where we might have something left over from the year before. Let's say that we figure out that we have wages and salaries payable on December 31st of $1,000. But we look and see that from last year we have carried over up in here under wages payable. It's not there, but if there was wage payable 400, all we need to do is adjust to get to the $1,000. So we might credit, payable, and debit expense. So in this case, we're just going to say that we look up all the payable, and the amount is $450, wages payable. Oops, put it in the wrong place again. And that's going to be a debit to wages expense for $450. And again, that would be calculated by looking at the hours, rates, since the last time that they actually received cash. So you have to be careful because days have to be added up. You want to look at when the last pay period ended and how they got paid. It can be several days. It can be more than a week. If you're paying every 2 weeks, it could be as much as 2 weeks, especially if there's a lag between the time that the end of the pay period and when you get paid. It can be 2 weeks of pay that needs to be accrued that way and adjusted. And if you don't, those are wrong. Now you see that these are adjusted. These are then can be used. Now we can go back and do our income taxes, and we're going to talk a lot more about taxes in a later section. Then we go back and we can work from here to get our income statement on our balance sheet. You see each of these accounts from the adjusted trial balance can be used on our financial statements. So that's kind of the process, that's the thinking and how it work. And I gave you some examples of going in either direction, what we might consider the asset way and also the expense way.